Good morning, everybody. My name is Kaushal, and welcome to the show. We're just waiting for the clock to tick over to 11, which I believe it just has. Why don't you give me a thumbs up if my audio is clear and you can hear and see me right now on your screens, right? So give me a thumbs up and welcome on this Friday morning to what we call MarketMaster's edition of Do It Yourself Investing in Mutual Funds. My name is Kaushal Bhagi, and I'm going to be your host, and I'm going to be with you for the next maybe an hour, maybe just a little bit more than an hour, below an hour. So, welcome everybody to this show. And this is on Do It Yourself Investing in Mutual Funds. So, I think by the end of this program, whether you're a non investor, whether you've recently started, or even if you've been investing for some time, there is going to be something key that you are going to be able to take away from this. And what you are going to be able to take away from is clarity in terms of how you want to go and start or prepare yourself for this journey of wealth creation. Again, for those of you who haven't known me or haven't met me, my name is Kushal. Hi, everybody. And I have a fair amount of experience in financial services and education. That's where I've spent most of my career. And I actually work with a number of H&I clients. I help them manage their mutual fund and other investments. But I'm also seriously passionate about the cause of investor awareness. And I love speaking to people about investor awareness, shaping their minds so they can understand certain topics that haven't ever been taught to us, as part of school, college, and growing up. And therefore, the benefits associated with investing are often lost on people. So I've been doing work on the investor awareness side actually for over 10 years plus. It's a passion project of mine. And when ET Money saw the kind of work that I was doing, they invited me over and said, hey, listen, why don't we come out with a sort of live webinar series, okay? Because that's what I sort of excel at, if I may say that. And my webinars are generally always live. They're very, very simple. So, very non technical webinar, okay? Because I believe if I'm going to speak to you and you're going to spend your time listening to me, it must be something that you can absorb, something that you can understand, and most importantly, something that you can action out over a period of time. So, I'm going to make you think over this course of the next hour, and I am going to be able to guide your thinking, okay? What we've come out with is Market Master, which is a web series, and we've got three very powerful live webinars for the do it yourself investor. All right. The first webinar is called Taking Your First Step to Building Wealth. So, all of those who've beginners, who've never invested before, who are looking to invest, or maybe who started very recently, this would be a great program for you to sit down and attend. How do you attend it? Well, hit the like or the subscribe button on the channel that you're watching right now, and we'll get in touch with you in terms of how you can go and sit down for this very motivating session that allows you to see the power of investing, but it also allows you, and we show you where exactly you're going to start. Okay. So people generally who are attending this first program, from a non-investor, they become an investor. Okay. Uh, the second program is Understanding Do It Yourself Investing, which is what you are for here for today. And I'm going to take you through what the flow of this presentation is going to be. The third and the last program in the series is called The Disciplined Investor, where it's a little bit more internal, and we look at the role of our own behavior, of asset allocation, and of a number of things like that on our investing journeys. Okay. Today, as I said, we're going to talk about do it yourself investing. I did a slide brief on active versus passive funds. So I have a lot of people asking me about index funds, good to invest compared to mid cap, small cap. Ram, what I would suggest is that, my style is that you sit back, aap kuch kaam mat karo, aap kuch zyada don't think out of context. All right. Allow me to guide your thinking. You just sit back and relax and try and absorb whatever I'm saying. I will try to make it very visual because there is a very clear flow to my presentation. Okay. First of all, what is the background to this do it yourself investing module? And the background is this, that, traditionally throughout history in the last 25, 30 years, mostly all investors who are investing in mutual funds have been using the services of a middleman. Okay. Everyone has been using the services of a middleman, and this middleman or the agent or the distributor would perform multiple activities. They would go and they would sell you something, they have to explain you something. At that point of time, not everybody is ready to start investing because it means it's almost like aapko kharcha karna hai, but you're not seeing the immediate benefit, right? So one really has to be convinced about selling it. Do teen baar milna hai, and this agent helps you start, and then he becomes your partner for life, right? Because investing is a long-term journey, and for that, the agent or the distributor gets paid. What's happened recently over the last 5 years specifically is because of the advance and advent of technology, and because how easy we use these smartphones. Nowadays, everybody has a smartphone, right? Everybody's on apps, everybody's doing all sorts of stuff. That has actually ushered in or heralded this big sort of tsunami in DIY investing. DIY is do it yourself, which is all what all of you are actually here for. And it's so simple. The user interfaces are so simple. It's so easy to go and buy a mutual fund. 20 years ago, a mutual fund would be the size of a newspaper. Today, you can just sit wherever you are and invest in a mutual funds. And not just that, you get to invest in direct plans, which can increase your returns. That's what we've been told. We're going to have a brief look at direct plans and regular plans today. All right. So it's made life very easy, and it's given us the confidence that we can actually manage to transact on our own. But actually, what we also have to take cognizance of, that it is a big responsibility. Do you agree with me? Give me a thumbs up if you agree that do it yourself investing is a big responsibility. Because as you would have seen in the first episode where we show you the power of investing, you can have a roadmap of how to get to sums that we had never ever thought about before in our past, over a period of time, through simple investing steps. If you are going to create a life and a future for your family, then that is a big responsibility. And what we're going to see today is do it yourself investing for everybody. Ye do it yourself investing mein hota kya hai, right? What all does it mean? Can everybody become a successful do it yourself investor? Is it only meant for a few people? So, what I'm going to show you today is really a step by step way to think and to plan your investments such that you will become a better and more successful do it yourself investor. I want to tell you that there's a little bit of lag, whenever we do things on YouTube. There's a little bit of lag, maybe around 10 seconds, in terms of when I speak and when you can hear me. So I have to play around with a little bit. So whenever I ask you to give me a thumbs up, etc., just flood my screen with thumbs ups, etc., because I know we're all on the same page. All right, it's a little difficult because we're not seeing each other. I'm not in front of you right now, but if you can help me a little along this process, that would be much easier. What is the flow of this presentation going to be? How do you define multiple goals? Look, when you're starting out with your investments, there are two things that you can do. All right. The first thing that you can do is have one goal. You have one goal, and that one goal can be wealth creation. And you sit down and just attack one goal, try and make investing a habit for the first 3 to 5 years of your life. But there are people who also, once you've got investing as a habit, you want to have multiple goals because you need money at different points in times. You need money for different periods of time. So, how does one go about and define various goals that you have? Once you have defined your goals, all right, we need to identify fund categories that fit those goals. Okay, that fitment is very, very important. Once we've identified the categories, when I say categories, I'm talking about whether it should be equity, whether it should be pure equity, whether it should be balanced funds, whether it should be debt funds. Okay, so all the various categories in mutual funds, once we've identified and mapped those, then we need to decide whether we want active funds as part of our portfolio, passive funds, or we need a mix of both. And the next decision to take is how do you actually go and select a scheme? And I'm going to show you that today with the help of ET Money's report card, which is quite a slick feature that they've got on. We're going to end the program by saying you've done all of this. Now we just need to understand how much do we need to invest on a regular basis, whether lump sum or SIP, so that we can get to our goals on time, and monitoring and reviewing becomes a key feature of being able to do that. So why don't you type a let's go or give me a thumbs up if all of you are ready to dive into this particular chapter. And like I said, just sit back, relax. Don't ask any questions that are out of context. I would actually say towards the end of the program, right? Whether you want to ask certain questions, ask it at that time. So it might be easier for me to see the questions, and I'll try and do a little bit of Q&A at the end of my program. All right. But there is a certain flow to this presentation. So go with the flow. Allow me and give me the honor of being able to guide your thought process. And let's go and see where this takes us. Okay. Wonderful. Look at the enthusiasm. So let's go. One is the starting point, which is how do we actually go and set up our goals? Before we look at how to set up our goals, it's important to say what a goal actually means. And the definition of a goal is something like this. You have to think to yourself, what is your current age? Let's say your current age is 30. A goal means you have to define the purpose of your goal, right? Why do you want to invest? And you want to invest, maybe it's for retirement, maybe it's for travel, maybe for education. So you have a purpose and you give that purpose. When do you need the money? All right. You need the money, whether it's after 30 years, 25 years, after 5 years. When is your goal going to actually materialize? When are you going to spend that money? And then the final thing is, how much money are you going to need? All right. So a goal means I am 30 years old. I want to retire after 30 years, having 5 crore rupees in my bank account. That is the definition of a goal. All right. And the starting point of all definition of goal, if you want to set up a goal, is depending on when you're going to need the money. When you want access to the money is going to determine everything else. When I'm going to say when you need the money, what I've done for you is I've broken it up into 4 buckets. This is called a bucketing strategy. A 0 to 3 a bucket means that you are going to require the funds to use the funds, utilize the funds within the next 3 years. Now, of course, if you're going to need the funds within 3 years, your main objective is going to be to protect capital, because you can't have too much equity in your portfolio, right? Equity can create a lot of wealth, but it can also destroy your portfolio in the short term. So, multiple debt products is, I guess, where you're going to invest in if you're going to need your money within this time period. 3 to 5 years, 3 to 7 years can be very tricky, because anything in life that we do for 5 years, 5 years is a long time. And if you're doing something regularly for 5 years, there can be an entitlement to some reward. Right? You want to be rewarded. 5 साल अगर आपने लगाए हैं तो कुछ तो मतलब benefit होना चाहिए, right? So the objective is that you definitely want returns, but you don't want it at the cost of very high risk. Because again, 3 to 5 years, 7 years is not that much time in that sense, right? If you're going to utilize the money. So we're going to see what kind of categories, what kind of funds fit this bill. But hybrid funds is a real good, solid fit for this particular bucket if you're going to need your money in 7 to 10 years plus. This bucket is actually made for wealth creation. This bucket is made for equity as an asset class, made for equity mutual funds and all the pure equity funds, maybe some aggressive hybrid funds as well, actually come and fit into this bucket. The last bucket that I've taken is opportunistic. And in this, I've got direct equity. Some of you are PMS investors. You want to invest in crypto, you want to invest aggressively in thematic or sector funds. I think this forms part of your satellite portfolio. All right, satellite portfolio, matlab side ka portfolio. Over here, you want to take higher risk, but your investment objective matches that risk, which is to go and generate some significant alpha. All right. Whenever I'm going to talk about equity, I'm pretty much going to figure on the 7 to 10 years and above category, because again, like I said, this is a tailor made for equity as an asset class. Given those buckets, what are the category of funds that you should be looking at? And if you look at the 0 to 3 year bucket, where the objective of your investment is to protect capital, then you cannot take too much of equity exposure. So if you need your money very soon, maybe even a bank fixed deposit is fair enough. It's fair enough as an option. Or you can look at liquid funds. Arbitrage funds, generally, if you have a period of 6 months and over, can be better than liquid funds. Okay, they can be better than liquid funds because they have an equity sort of taxation. All right. So if you need your money within a year, then arbitrage funds below 6 months, maybe liquid funds is where you could go and invest your money. For maybe 2 to 3 years, you could look at short duration or corporate bond funds or banking and PSU funds. And finally, for those people who want a sprinkling of equity in their portfolio, you can look at conservative or equity linked saving schemes. This will give you equity exposure of around 15 to 25%. So it's a little bit of a kicker, but I don't think if you need your money within 3 years, you should be going higher than 15 to 25% of equity. What happens if you need your money within 3 to 5 years or 3 to 7 years? I told you balanced funds are really made to fit to this category. A conservative hybrid fund, like you've seen above, is conservative in nature. So it takes maybe around 25% equity and 75% debt. Balanced hybrid में आपको 50-50 मिलेगा, and aggressive hybrid you'll get maybe around 75% equity and 25% debt. A balanced advantage fund is fairly interesting. It's a category where the fund manager, depending on their call of the market, moves the equity exposure between a conservative, balanced, and aggressive hybrid fund. So 25% लेके to around 80% वो equity exposure adjust करता है depending on what their call of the market is. Balanced advantage funds are actually those kind of funds. अगर आपके पास lump sum amount है invest करने के लिए, and you're always wondering, is this a good time to put in the market? Is it bad time? Market बहुत ऊपर गया है, overheated है, cheap है, etc., etc. I think balanced advantage funds can suck up lump sum amounts. आप बेफिक्र होके डाल सकते हैं in balanced advantage funds. And multi-asset funds is another category. यहाँ fund manager बोलता है आप मुझे पैसे दे दो, I will invest in equity also, debt also, gold, silver, real estate. सभी asset classes जो है will have some exposure. So it's an all-in-one fund, all right? And balanced fund generally within 3 to 5 years, 3 to 7 years is a really, really good fitment. If you're looking at 7 to 10 years and above, apart from some aggressive hybrid funds, which could form part of your portfolio, basically you're going into pure equity funds and all the varieties of pure equity funds, whether active or passive, large cap, mid cap, small cap, focused, etc. All of them fit into this bucket. All right. The opportunistic is when you are looking in search of alpha, when you want to take that extra risk. And I've kept mid cap and small cap in this bucket as well. But largely it's sectoral and thematic. When I say sectoral funds, for example, sector funds में क्या होता है? All your eggs are mostly in one similar basket, right? If that sector is going to do very well during a period of time, आपको outsized returns मिलने वाले हैं, but generally sectors can languish for long periods also. So मतलब opportunistic मतलब मौका, right? Getting in and getting out becomes very critical if you are going to invest in sector or thematic. So basically what I'm saying is you must have a lot of conviction if you are going and investing in these types of funds. All right. What are your bucket expectations? I know this might be slightly small for you to view at, but don't worry, it's a fairly easy expectation to have. The first line is अगर आपको 3 साल के अंदर पैसे चाहिए, obviously the amount of risk that you can take, you're going to be fairly conservative, and therefore your expectation should also be conservative. देखो, over a long period of time, debt can protect your capital. It may be able to do little bit better than inflation, लेकिन ज़्यादा आप wealth नहीं create कर पाओगे, right? In this bucket, because it's conservative, lesser equity exposure is advised. And as I keep saying, if you are going to invest for a period of 3 years and above, then debt mutual funds have a lot of tax benefits associated with them, जहाँ आपको बैंक FD में मिलता नहीं है. So your net take-home return is extremely high, or it's a rather good alternative to a simple bank fixed deposit. I'm not saying you can't get more than 6%. There have been short-term funds and banking and PSU debt funds, which in the last 3 years have given you 8 and 9% returns. But I'm saying expectation आप थोड़ा संभाल के जाओ, right? Don't invest in those funds thinking that आपको 9% ही मिलने वाला है. Around 4 to 5 to 6% should be what your expectation can be. If you are going to look at investing for 5 years, for 7 years, फिर आपको थोड़ा equity ज़रूर चाहिए आपके portfolio में. For 3 to 5 years, hybrid funds are a very good fit, whether balanced or aggressive hybrid funds. और आपके पास अगर 5 साल है, 7 साल है, then you can look at pure equity funds as well, especially in the large cap space. Because mid cap, small cap थोड़े volatile होते हैं, right? So I think large cap is a good place that you can invest in for a period of 5 to 7 years. Glide path becomes very critical. I'm going to tell you at the end of this presentation कि glide path का मतलब क्या होता है. Okay, 7 to 10 years and above, I said it's tailor-made for equity as an asset class and a good expectation to have. अगर आप 10-15 साल के लिए invest करने वाले हो, then 4 to 6% above inflation. Okay, so if inflation is around 6 to 7%, तो मतलब 11-13%. So around 12% is a good expectation to have from a long-term perspective. And when I talk about opportunistic, you're being really, really aggressive. If you see an opportunity and it's only mocha, it's only going to be there for a short amount of time, so lump sum investing makes sense because you have so much conviction that this particular stock or this particular sector or this particular fund or this particular theme is going to do well in the next 2 years. तो मतलब ज्यादा पैसा उसमें डालो, no, so that you can make a lot. But if you want to invest in very aggressive schemes like a small cap or a mid cap, then maybe as a starter SIP method is recommended. You can of course invest in lump sum, but you have to be comfortable handling that volatility. All right. And finally, international exposure. I think once you are a reasonably regular investor, okay, once you are a reasonably regular investor, you can take 5 to 10% of your portfolio in international funds. And you can slowly build up towards that, right? You don't have to have the perfect portfolio just as you started investing. But clearly, the last bucket is that you are taking outsized risk because you are going for outsized returns. All right. Is everybody on the same page? Give me a thumbs up before I move on to the next chapter in this particular presentation. Keep giving me some feedback. Is this simple enough for you to be able to sit down and visualize कि मैं कैसे बोल रहा हूँ, क्या बोल रहा हूँ, आपको समझ में आ रहा है या नहीं? Just type me in the chat box so that I have a good idea about that. All right. Okay, let's move on then. And once we've decided, so we've seen how to structure our goals, and the goals we're saying depends on when we're going to need access to the money. Okay, once we decide when we're going to need access to the money, the next thing we've looked at is the category of fund, whether we should invest in pure equity funds, how much risk we should take. So, all that we have now got down and figured out. Now, the next step that is left is whether we should have active funds versus passive funds in part of our portfolio. And this is one of the hottest topics that is there, especially in the Indian markets today. I did around a 45-50 minute session on active versus passive last week. So I'll go a little bit quickly through active versus passive. I'll give you the basics, what we need to understand. But by the end of this particular module, I think you should be able to be very clear with yourself ki you want active funds only, passive funds only, or you want a mix that is there as part of your portfolio. All right, Mr. Srivastav, I'll take questions at the end. So just copy paste them at the end. Perhaps we can do that. I hope that's agreeable. Okay. All right, let's go on. What I've done is I've given you difference between active and passive funds across various purposes. And the one main difference that you really need to look at is the allure of active and the allure of passive. What is the allure of active funds? Why do people like active funds? Active funds का मतलब क्या होता है? Active funds का मतलब होता है कि the fund management team at the mutual fund is actively creating and constructing the portfolio. They are deciding what to buy, how much to buy, when to sell, what the makeup of the portfolio should be. That is what the job of an active fund manager is. And each active fund is benchmarked against an index. Okay, हर active fund जो है उसका एक benchmark होता है. So a large cap fund which is actively managed will be benchmarked against a large cap index like the Nifty 50, Nifty 100. A small cap fund will be benchmarked against a small cap index. And because it is an actively managed fund, the stated objective of it being actively managed is that it should try and deliver returns that are better than the index, that are better than the benchmark. Right? So everybody has a benchmark, they all have to try and better the benchmark. In a passive fund may there is no flexibility given to the fund manager in terms of how to pick and choose the stocks. Okay, if a fund manager is trying to copy the Nifty 50, then they have to copy the Nifty 50. Matlab Nifty 50 is 50 stocks in different weights. So those same 50 stocks in the same weights as is there in the Nifty, they have to try and copy. They have to have same stock, same weightage. तो क्या होता है उसका रोल काफी लिमिटेड होता है, and because the role is fairly limited, even the costs are very less. It's not जहाँ एक्टिव फंड मैनेजमेंट में पूरी टीम, पूरी फौज, पूरी सेना होती है, analysts, researchers, sector specialists. You have all different types. They cost a lot of money, right? So you're going to be able to go and do that. But if you're looking at a passive fund, it's not that much work as an active fund, so the costs are less. And that is the allure of a passive fund, to say, I don't mind investing in a fund that keeps its costs low. And active fund may be able to beat market returns, but it may fall short of market returns also. तो मेरे को वो झंझट में नहीं पड़ना है. I am happy earning market returns. I am happy keeping my costs low and focusing on just remaining invested for long periods of time. If somebody else is getting better returns, good luck to them. If somebody else is earning lesser returns, bad luck to them. मुझे market returns ही लेना है. If you're okay with this, give me a thumbs up as I move on to the next page. And the next sort of chapter, and this is something that people keep asking me, maybe it's a question that you all have as well, is that index fund and ETF, what is the similarity, what is the difference, which is a better one to invest? I actually take a pretty easy, simple, and a little bit non-technical view of it. Index fund and ETF matlab same hai, lekin thode bahut alag hai. It's almost as if they're two sides of the same coin. And the only real things that you need to remember over here are the buying process. Index fund is like buying just another mutual fund scheme. So like you're buying a blue chip fund or you are buying a mid cap fund, you are going and buying an index fund. Right? Let's say a Nifty 50 index fund or a Nifty 100 index fund. You buy it in the same way you buy any other mutual fund scheme, which is you go to the mutual fund, you look at investing X amount of rupees, and you get N number of units at an end of the NAV. An ETF, or an exchange traded fund, as the name suggests, are traded on an exchange. So you're going to buy it exactly like how you're buying direct equity, exactly like how you're buying shares. Okay, that is the main difference. So in an index fund, you're getting an end of day NAV. In a share or in an ETF, you're buying it during market hours. All right. What you really need to remember in index fund and ETFs is this. Number one, the purpose of the objective of index fund and ETF is exactly the same. Okay, both of them are looking at tracking a benchmark. So you can have a benchmark like a Nifty 50. Index fund भी track कर रहा है उसको, ETF भी track कर रहा है उसको. And honestly, both of these are low cost options. I don't like to get into a debate in terms of which is lower because there is such a minimal difference between the costs if you actually look at it. अपने को क्या लेना देना उससे? Both of them are low cost strategies. Okay. I would prefer index funds if you are an SIP investor because it's a little bit more convenient. So if you're an SIP investor, I think index fund is the way to go. If you're a demat wala and you keep doing a lot of day trading, etc., then maybe ETFs is more your cup of tea. Variety to sab mein hai. Unfortunately, today what is happening in the industry, whether it's active funds, whether it is passive funds, there are so much variety of funds to choose from, and this is only going to get harder. This is only going to get tougher. This is only going to get more complicated. Same way in index fund and ETFs, variety hai. Right? You will look at market cap weighted, which is typically Nifty 50, Nifty 100 types. Agar aapko sector mein invest karna hai, if you want to invest only in public sector banks or only in pharma sector, there are funds available for you to do that, both index and ETF. If you don't want to buy physical gold or silver, you can actually now buy it through index funds and ETFs. You want to invest in international funds, right? We want to own some of those stocks in the Nasdaq and S&P, etc. We can actually have access to that through index funds, through ETFs. Smart beta is something which is upcoming. Again, I'm not going to get into the details of this, but factor and smart beta matlab they are taking certain factors and creating rules around those factors to give you a portfolio. मैं थोड़ा समझाता हूँ आपको. Nifty 50 we said is a market cap weighted index, right? Nifty 50 market cap matlab 50 stocks. The bigger stocks have a larger weightage in the Nifty. The smaller stocks have a smaller weightage in the Nifty. Now you are saying Nifty 50 equal weight. So I'm going to construct a portfolio for you where I am going to go and give you 50 different, so 50 of the same stocks, but all 2% weightage. तो बन गया ना नया portfolio. Or LV50. मतलब I've identified a certain universe of stocks. From those stocks, I'm going to pick 50 of the stocks that have the lowest volatility. बन गया ना आपके लिए portfolio. And you can invest in debt as well. But the most popular one and the one that we're going to be actually focused on today is market cap weighted indices to say if you want passive funds in your portfolio, maybe a Nifty 50 or a Nifty 100 is a good starting point. All right. So we've just scratched the surface. We're seeing what is the difference between active and passive. We're saying active may you can earn more, but you can also earn less than the particular benchmark. Passive fund may you are going to earn benchmark returns only because it is designed to track a benchmark and variety is there as far as everything is concerned. All right. One thing you must understand is that almost all investors today have active funds as their core portfolio. Active funds are really, really popular. In fact, active funds in India, 90% of the total funds are active funds. And the main reason why it is so is that active funds are much older than passive funds. Much older than passive funds because that has been available. Because that has been available, everybody has it as part of their portfolio, right? And fund managers who used to actively manage these funds were able to give out solid performance. And because they were able to give out solid performance, people obviously said, let's go to active funds because udhar market se zyada return mil rahe hain. All right. That's why a lot of people have active funds as part of your portfolio. So you might be asking then, why is there this sudden interest in passive investing? And I'm going to dive one step little deeper right now. So just pay a little close attention, although I'll make it fairly easy for you guys to understand. Okay. In 2018, SEBI undertook a vast exercise called recategorization and reclassification of all mutual fund schemes. What it said was, number one, the aim of an actively managed fund is to beat the benchmark over a period of time. And that's what we've already seen. That's what we've all understood. That's the purpose. That's how an active fund manager is going to be judged, right? Whether they're able to beat the particular benchmark. Obviously, the benchmark has to be an apples to apple comparison. मतलब क्या होता है? मतलब if you have a large cap fund, then you have to be benchmarked against a Nifty 50 or a Nifty 100. अगर आपके पास small cap fund है, चला रहे हो, then you cannot benchmark that to the Nifty 50, right? You are going to go and benchmark that against a small cap indices. All right. Now, what happened was that SEBI spotted some instances where this comparison was flawed. What they said was that if a large cap fund is investing in large cap companies and is benchmarked against a large cap index, kabhi kabhi kya hota tha? The fund manager would be able to see some great opportunity in mid cap, small cap, and he used to take his AUM and move it and slant it towards mid cap and small cap. substantial amounts. SEBI said, यार ये बात तो सही नहीं है ना. If you are comparing yourself against a large cap index, then you have to have large cap stocks. If somebody wants to go and select a mutual fund, and let's say they want to look at performance, you can look at performance, but you have to be within the mandate. No, you cannot go and stray from the mandate. And therefore, in the name of transparency, and SEBI is pretty big in the name of transparency, they introduced various categories for various types of mutual funds. Let me give you an example of this. For example, it said large cap is defined as the top 100 companies by market cap. There are over 5,000 companies that have taken money from the public today. SEBI has said the top 100 companies by market cap, उसको large cap बोलते हैं. और अगर आप फंड मैनेजर हो और लार्ज कैप फंड चला रहे हो, then 80% of आपका पैसा जो है has to be invested in these top 100 companies. Does that make sense? Then they looked at mid cap funds, and it defined a mid cap fund, it defined a small cap fund, and it gave you further rules also, right? To say these are the companies that you can invest in, और इतना पैसा ये company में डालना चाहिए. तो क्या everybody has to be able to go and stick to that particular mandate. All right. Now, what actually started happening as a result of this is that all the mutual fund schemes had to align their portfolios a little bit to adhere and stick to these rules. And as a result, if you look at the large cap space, is all portfolios started to look fairly similar. All right, all portfolios started to look fairly similar. What I'm going to do is I'm just going to move away from this presentation and I'm going to share my screen. And this is just a website that I've used where I am looking over here at a portfolio overlap. So over here, for example, I'm looking at a small cap category. And in the small cap category, we have two funds over here, the Axis Small Cap and the DSC Small Cap. Over here, what you're saying is the common stocks both these funds have in their portfolio. Abhi small cap mein, you can see that the common stocks are fairly less, right? Because small cap, again, you've got 250 stocks to choose from. That's a very big universe. So everybody can have different stocks. There is very little overlap as far as that is concerned. But suppose I go and we look at what's happening in the large cap space. And in the large cap space, let me take two of the more popular fund houses. Let's say HDFC and ICICI. Okay. And if we go and check this out, what you're actually seeing over here is that there is a lot more commonality in their portfolios. Are you able to see that? There's a lot more commonality in the portfolios because there are only 100 companies to choose from, right? And if there are only 100 companies to choose from and everybody is having the top few stocks any which ways, then everyone's portfolio is going to look alike. So there's not much difference between an HDFC top 100, between a Birla Frontline, between an ICICI, between the Nifty 50 and between the Nifty 100, because they all have fairly similar stocks. All right. This is something to keep in mind. I'm going to come back to this in just a moment. The other reason why passive funds have sort of been in the limelight, if I can say that, is because of the advent of online platforms like ET Money and various other ones that have come about in the last few years. Costs have started to come into focus. They go earlier when you were investing in active funds. Most people, like I mentioned, were investing through an agent. They were investing through a distributor. डिस्ट्रीब्यूटर को पैसिव फंड्स बेचने में, इंडेक्स फंड बेचने में ज्यादा मजा नहीं आता क्योंकि उसके पास ज्यादा कमीशन नहीं है, राइट? पैसिव फंड इज अ लो कॉस्ट फंड एनी विच वेज, राइट? सो इट डजंट हैव एनी मार्जिन. बट नाउ इफ यू आर गोइंग एंड इन्वेस्टिंग डायरेक्टली, then you can look at passive funds a little bit more. And before we look at passive funds, I'm going to talk about direct plans for a little bit, because that is what you get with all these platforms, including ET Money. Very quickly, I'll take you through expense ratio. Expense ratio is the amount of expenses that a mutual fund scheme is going to charge you, okay, is going to charge you for investing in their scheme. And essentially what SEBI said was that from 2013, it's been almost 10 years now, all mutual fund schemes must necessarily have a regular plan and a direct plan. The portfolio is exactly the same. The fund manager is exactly the same. The only thing that is a little different is in terms of the expenses that is charged, because if you are investing through a regular plan, you are buying it from an agent and that has some inbuilt commission built into it. That is why you will see that the expense ratio of a regular plan is always higher than the expense ratio of the direct plan of the same scheme. But there is no difference between the portfolio of both these funds. The only thing that is different is the NAV. All right. I'm going to take you and show you very quickly how this expense is actually generated. This might be, I don't know if it's that visible on your screen, but I'll try and read it out for you. I've taken a fund, very popular fund called HDFC Top 100, and we are saying that this is a fund in the large cap space. They have a regular plan and a direct plan. In a regular plan, the expense ratio is 1.7%. In a direct plan, it's around 1.1%. Okay, so expense ratio in regular plan is higher than the direct plan. On 1st Jan 2013, the NAV of both are exactly the same because their portfolios are exactly the same. But what is happening over a period of time, you are charging more expenses to the regular plan. How does it actually work, right? It actually works like this, that a mutual fund scheme will charge you for every single day that you are remaining invested in the fund. So if you've got two schemes, what it does is it will charge you the expense and then it will publish the NAV. So every day before publishing the NAV, it charges you the expense for that particular day and then it publishes the NAV. So what will happen over a period of time if you got regular and direct, and let's say on day one, both of them are the same price, okay? NAV matlab price. If you are going to reduce 2%, for example, on the regular plan, matlab 100 say 98 ho gaya, so the price is 98. In a direct plan, you're minusing only 1% because the expenses are less, so the price is 99. Every day, if you keep doing this, every day, if you keep doing this over a period of time, you're going to see that the NAV of a regular plan is higher, is lower rather, than the NAV of direct plan. And that is what it means in terms of higher returns as well. Okay. Same thing. I'm just taking another example of Aditya Birla Frontline Equity Fund. Again, you'll see the expense ratio of regular plan is higher than the expense ratio of direct plan, which actually means that over a period of time, the NAV of direct plan is higher because you're minusing less expenses, and therefore your returns are much higher. Does that make sense? Yeah, all you guys, huh? All these questions at the end. First, focus in terms of what I am saying. If you're able to grasp this, this is going to be really helpful for you guys. All right. So, Mr. Bandare, Mr. Sharma, etc. I'll talk about all your questions at the end. पहले इस पे थोड़ा ध्यान दो, फिर देखते हैं. It's fairly interesting what you're going to see now. So what you're going to see now is, and that's what we said 2 slides ago, that at least large cap space में, that in the large cap space, सबके portfolio same दिख रहे हैं, right? Because सबके पास same stock है, तो HDFC top 100 के बीच में, frontline equity के बीच में, और index के बीच में. So what I've gone and done is taken out an HDFC Nifty 50 index fund and a top 100 index fund. All of these funds have pretty similar companies, but I will draw your attention to the expense ratio of the index funds. और आपको यहाँ दिखाई दे रहा है why these are called low cost funds, because the expense ratio is not 1.8%, is not 1.2%, is only 15-20 paisa, right? So it makes sense to think that all things being equal, if all the active and passive funds in the large cap space are going to give a fairly similar experience, maybe there is merit in saying that I should select the fund which has the least expenses, right? If all of them are going to give you the similar experience, if all of them have the similar stocks, isn't the percentage play to be, or rather go and invest in a fund that has the lesser expense ratio? Well, I think that line of thinking is the right way to do it. But of course, there is one other thing that we have to look at, and that is the returns, right? The other point of view is going to be that, Kushal, I don't mind paying higher expenses to active funds as long as they're able to beat the benchmark. Then what do I care? They've earned their money, they've earned their keep, as long as the performance has been better, right? So what I went and did is I went and took out some performance data, and this was as of December 21 of last year. All right. And what you're seeing over here is the percentage of large caps that have been able to beat the benchmarks. And I'm drawing your attention to the middle diagram. The middle diagram says in the last 5 years, and get this, only 18% of the funds, only 18% of the active funds have actually beaten the benchmark. Matlab 8 out of every 10 times, the benchmark has been beating actively managed funds in the large cap space. So, ये नहीं बनता है कि if we are now looking at having large cap funds in our portfolio, there can be a case to say, since all of them are giving us the same sort of experience, let me go and invest in the one that gives me more returns. And over here, you're seeing the benchmark fund is what is giving you more returns. What about in mid cap and small cap? In mid cap and small cap, you'll see that it's more 50-50. There seems to be more opportunity for people to go and outperform the benchmarks in the mid cap space, but it's still almost 50-50. Right? So fairly interesting. And this is what has been happening in Indian markets in the last couple of years. apart from large corporates and EPF that have been investing in passive funds, even the retail investor has been saying, yaar, index fund mein dalne ka thoda sense lag raha hai. I went and took out some data to say what's happening with equity funds in the US, because US may, as you can see what I've highlighted down, you've got a lot more history, you've got a lot more time period. The middle one, you're looking at last 15 years, and you're saying 15 saal mein in the US, all equity funds, all active equity funds, only 14% of them have been able to beat the benchmark. In the last 20 years, you're saying 9 out of every 10 times the benchmark is actually going and beating the actively managed fund. And that's a pretty surprising number, right? And that's what you're seeing now on the right hand side of the screen. What is in orange is the passive component. In 2010, passive funds were only 20% of the market. In 2019, they were almost 40%. And finally, in 2025, it's projected that passive funds are going to be even bigger than active funds. So, to have a question or to have an answer to the question whether passive funds should occupy a part of your portfolio or not, the answer is an unequivocal yes. I think it's high time that passive funds should form part of your core portfolio, and the one to have is a Nifty 50 index fund. All right, that is the most popular fund to sort of have. Give me a thumbs up if all of y'all are liking what y'all have been hearing so far, if everything is going smoothly, if you are able to visualize what it is that I'm talking about. Why don't you hit a like or a subscribe in the channel if you haven't done that already? All right, what have we done so far? What we've done so far is we first looked at your how to set up goals at a portfolio level. All right, we said list down your goals, and you're going to list down the goals basis on when you are going to need access to your money. Okay, that's what we looked. Then after we've done that, we said we've identified the category what we must select. Pure equity lena hai, balance lena hai, balanced advantage lena hai, mid cap lena hai, small cap lena hai. After that, the decision to take was, should you have active funds? Should you have passive funds? Should you have a mix of both in your portfolio? There's no need to overhaul your portfolios right now. But I think what we can take from it is that large cap space maybe it makes sense to take an index fund or a Nifty 50 index funds. The rest of the stuff we can go and we can look at actively managing that particular fund. All right. Great. And finally, we're coming to the process of selecting a scheme. We've decided we want a Nifty fund. We decided we want a mid cap fund actively managed and a small cap fund. Abhi scheme kaise select karte hain, right? That is something that we are going to go and have a look at right now. First of all, when you're going to select a scheme, it depends whether you're going to select an active fund or a passive fund. If you are going to select a passive fund, and passive fund, I'm talking only Nifty 50, okay, for now, then as you can see in this data that I've put up, मतलब ज्यादा दिमाग नहीं लगाना है यार. Because just think about it. No, all the fund houses, all the AMCs are very big AMCs. They are very good AMCs. They're very professional AMCs. And Nifty 50 index fund, matlab what? What are you trying to do? You're just trying to copy from the Nifty 50, right? It's like an examination classroom where everybody is trying to copy one person's paper. थोड़ा बहुत फर्क होगा, but largely they're going to give you the same sort of results. So I would actually think, and you can go and look deeper into stuff like tracking errors, etc., if you want to, but I don't think there's a need to get that technical. If I want to select a Nifty 50 fund, what I'm going to do is I'm going to look at the list of various AMCs that are there, various mutual funds that are there. I would go to the AMC which I'm comfortable with. Maybe it has to do with size, maybe it has to do with familiarity, maybe I have a bank in that account, so I've taken that. I would just go to one of those AMCs and simply pick their Nifty 50 fund. All right, and that is all that I would actually need to do to go and get started. Fund selection and scheme selection becomes a lot more fun when you are looking at active funds. And for the purpose of looking at active funds, what I'm going to do is I'm going to play around with the ET Money report card. All right. And an ET Money report card looks something like this. All right. This is how it looks on your app. But since the app is a little small, what I'm going to do once again is I'm going to share my screen, and we're going to go and have a look at the ED Money website, and that is up on your screen now. So on the ED Money website, which is edmoney.com, I've searched for mutual funds, I've searched for equity funds, and I've selected multi-cap mutual funds. Okay, so let's go and have a look at a report card. Let's pick up the Parag Parekh Flexi Cap Fund. Okay, and I've put this up on you, and the first thing that strikes me is that this is such a slick looking report card to look at, right? Maza aa gaya ye dekh ke. right? And if you look at this right now, what you're saying over here, it's giving you the name of the fund. It's confirming that you are indeed investing in the direct plan. And over here, it gives you a ranking, right? So this fund is ranked 4 out of 33. Now, one of the things that people look at when they invest in equity funds, how do you select a fund? A lot of people do it only on the basis of last year's return, and that's not exactly the right thing to do. You have to look a little bit of deeper, and what they've done through this report card is giving you an idea of how to look. And I'm just going to take you through 5 minutes. What are the various factors that they've considered? If you want to know more about this in detail, then on ET Money's YouTube channel, there's a fantastic video of ET Money report card. It's around 15 minutes, so you can go and check out. But mota, this is what it is. The first thing that it looks at is performance quality. And when you talk about performance quality, it essentially means returns. All right. There are two factors that they look at. Number one, has this Parag Parekh Flexi Fund been able to generate returns consistently? Matlab, has it been able to beat the benchmark? Right? The purpose of an active fund is to beat its benchmark. Has it been able to do that consistently? And for that, this fund has got a score of 4 out of 5. The second one is, has it how much risk has it taken to give you those returns? That's called the Sharpe ratio. Imagine there are two funds, both have given you a 12% return. One of them has taken a risk of 10, the other has taken a risk of 6. Then obviously the fund that has taken a risk of 6 is better, no? It's taken lesser risk to give you more returns. So on that, this fund has scored a 5 out of 5. So this is one of the main criteria that they look at. But what they've done in this report card, they've also considered certain other factors, and one is downside protection. They're saying that markets go up is okay, but when markets going down, then how is the fund done? Have you fallen lesser than the benchmark, more than the benchmark, equal to the benchmark? And over here, what you're saying is that control losses during market corrections, that funds have actually fallen lesser than the benchmark. That is why it has got a high score. The last one is volatility, right? A lesser volatile fund is always more preferable to a highly volatile fund, because highly volatile fund means our heart rate is really increasing. So if you're able to give consistently good returns with lesser volatility, this fund has scored fairly well on that, and this has earned it a score of 4 out of 33. If you scroll down, this is one of the other things I like in this report card. It's also giving you the VRO, which is Value Research Online, which is another website, is giving you their ratings as well. And you can see over there, this fund has got a 5-star rating as far as value research is concerned. All right. I'm going to go back and let me share my screen over here. So let me clear this selection, and let's compare a few funds and just have some fun looking at all of these. Okay. So I'm just going and selecting 3 or 4 funds, and I just want to show you the kind of data that is available, so you also have an idea of the kind of work that has gone in to actually be able to give you these rankings. So I've selected these 4 funds. You can do that, and then once you have the compare again, what it gives you is something which is so neat. And over here, you can see that you've got the rating of all these funds in this category, and you've also got a value research rating. So this is a 5, 4, 2-star, and a 1-star. So the funds on the left seem to have done much better than the funds on the right, right? Why is that the case? Why have the funds on the left got a higher ranking? Let's go and have a look at returns first, and returns over various time frames. But as you can see, over 3 years and 5 years, these two funds have done significantly better than the funds on your right hand side, and that's what's enabling them to get a higher rating and a higher ranking. All right. If you look further down, you're looking at various risk measures as well. Standard deviation is volatility, lower the better, and all of them are fairly okay in the 19 to 21 range. When you look at Sharpe ratio, higher the better. I'm not going to get into details again of what these ratios are, but a high Sharpe ratio means you've taken lesser risk to generate more returns. And if this is much higher, you can see the Sharpe ratio of these are fairly lower, right? The same thing as far as your Sortino is concerned, higher the better. So again, I'm not getting too technical, but essentially there is all this data that has been taken into account while giving a ranking and a rating to these particular funds. And you can go and see the expense ratios, you can check out the exit loads, and you can see all these particular details. All right. Does that is that good enough for us to see? Was the screen frozen? Oh, I'm sorry. Maybe you aren't able to see the comparison or the scheme posed over there. All right. I had no idea about that. Let me try it again. All right. Let me try going to screen share once more. And let me look at the tab. Let's look at index funds right now. Are you able to see the screen at this point in time? Are you able to see the screen now? Are you able to see the screen now? If you are able to see the screen now, then you can just give me a quick thumbs up, and then only I'll continue. We have maybe another 10 minutes left in this presentation, so it shouldn't be that much. Okay, if you are able to see the screen now, over here, what I've done is I've selected various index funds, okay, the main index funds of these particular big AMCs. And as you can see over here, I told you an index fund, it's not that much to sort of think and see, right, in terms of what you're going to see. And you can see over here, the returns are all fairly similar here. 19-20 का फर्क होता है रिटर्न्स में. Look at this. 7.7, 7.7, 7.7, 7.9 in the last 1 year. Over the last 5 years, you've got 12.6, 12.5, 12.4, 12.7. Right? You look at the standard deviation, all the volatility, they're all the same. You look at the Sharpe ratio, they're all the same. All the metrics are the same. All the beta is the same. All right. And this is why I say it's not a very big decision to be able to go and select index funds may what one you should have. All right. Is that visible? Were you able to view that? Were you able to view that? You want me to try and show you the comparison of let me show this one again. Okay, not this. So let me close this. Sorry, what is this mutual fund? Yeah, okay. So let me come here. I'm just trying to pull up that screen again for the active funds, which you all should have been able to see. Okay. So just give me a moment and let me try that. Ah, there we go. I hope you would be able to see this now. As you can see over here, that the funds on the left have a higher rating and a higher ranking than the funds on the right. And if we scroll down, this is why, because their returns seem to be substantially higher. Okay, their returns seem to be substantially higher than these. And even their ratios, the risk measures, they score much higher than the risk measures from left to right. So again, like I said, I won't get into the details of all of this. You can go and check out the video if you are interested on it. But what I would say is that there is some homework that has been done, and this is going to save you the homework, right? If it is going to save you the homework, what am I going to say? What actually are these? What actually have these done for you? All right. If you'll actually think about it, what they've done is they've only given you the past track record. Do you agree with that? Give me a thumbs up if you agree with that. That all they have done is given you the past track record. It doesn't mean that if a fund has done really well in the last 5 years, it is going to continue doing as well in the next 5 years, or if a fund has done a little poorly, it's going to continue to do poorly. Right. I think where this would help with you, and this is how I would pick an active fund. If I've identified the category, I would go and do my research. I would check out the ET Money report card, and I would look at a good ranking. All right, maybe in the top third, etc. Because rankings will also keep going up and down. I would look at the top ranking. I would go and check out a value research. I would validate it over there. Kitty ke iske paas 3 4 star, 3 4 5 star hai. I'm able to do that, and that is all that I can do. I can't control whether my fund is going to do as well or a little bit poorer in the times going ahead. But why this process to me makes sense is, see, if you've done your research and done your homework and picked a fund with a good track record, then even if the fund does a little bit less well or does a little poorly, at least you did your homework, no? But if you pick a fund with a poor track record and then that fund is going to do badly, then you might feel a little bad about yourself. Okay, so it's not rocket science. I don't think it is possible to be able to pick the fund that is going to deliver you the best returns. But yes, of course, fund track record has to be rewarded. And that is one way that you could go about and select your scheme. I hope that's fine. Give me a thumbs up if you all are in agreement with what I've said, that it helps you in terms of fund selection. All right. So we've come so far, and finally, the only thing left is how do you go about now and determine? So we've selected everything, right? We've selected the funds also, we've selected everything. Now we want to go and play around and see how much do we need to invest to be able to reach our goal on time. All right. And for that, what I'm going to do is, once again, I am going to go into screen share mode and we're going to play around with a little bit of a calculator. Okay. And when I say calculator, again, what I'm doing is we're going to ED Money's website. Let me clear this. And in their website, if you go to more, there's something called an SIP calculator. This SIP calculator is fairly simple, and I keep playing around with it, and you guys can play around with it as well. What it is saying is that if you are putting 5,000 a month for a period of, I don't know, 25 years at 12%, you would have invested total of 15 lakh rupees, and the value of that 15 lakh would be around 95 lakh rupees. Are you able to see the screen? I hope the screen is not freezing for all of you as far as that is concerned. Just give me a thumbs up so that I know we're okay as far as all this goes. All right. Now, what we're going to do is that suppose we're going to play around with this calculator a little bit and say, suppose I know my goal amount. Suppose I know my goal amount. How much is it do I need to invest to be able to achieve and reach my goal on time? So I'm going to click on I know my goal amount. And let us say that my daughter is 5 years old. I want to save for her MBA education by the time she's 25 years old. So I'm looking at investing for a period of 20 years. Okay. And if I'm looking at investing for a period of 20 years, how much do I want to save? I am saying that that MBA education today costs me around 30 lakh rupees. All right. Now, what are we trying to say over here? I'm trying to say is that if the MBA education is 30 lakh rupees and I'm going to need the money after 20 years, means I can go and invest it at 12% returns. If I am able to get 12% returns, then I need to invest 3,000 bucks a month. That means if I'm doing an SIP of 3,000 bucks a month for 20 years and earning 12% CAGR, I will reach my goal of 30 lakh rupees. But this is a simplistic way of doing it, because as we've understood that 30 lakh rupees today is not the same as 30 lakh rupees 10 years down the line, because महंगाई रुकती नहीं है. Prices were rising, are rising, prices will continue to rise. And therefore, what I'm going to do is I'm going to adjust the goal amount for inflation. And that button is over here. I'm just going to toggle this from N to yes. Okay. And it's given me three choices. Let me click the middle choice, and the middle choice is 6%. What we're saying is that what costs 30 lakh rupees today, in 20 years' time, if Mengai is at 6%, you're going to need 96 lakh rupees. You're not going to need 30 lakh rupees. And therefore, you don't need to invest 3,000 bucks a month, but you need to invest on average 9,600 rupees a month to be able to reach your inflation adjusted goal on time. Give me a thumbs up if all of you are in agreement that that is one reason why all of us actually need to go and continuously increase our SIP amounts at every given opportunity, because 3,000 bucks that you're looking at today is not the same as 3,000 bucks 1 year down the line, 2 years down the line, 3 years down the line. So every given opportunity that you have, you must go and you have to increase your SIP amounts. Are we all in agreement as far as that is concerned? Great. There is another way of doing it, and some of you all might think, yeah, I have some lump sum amounts to invest as well. So how does lump sum investing work? So again, over here, I'm going to go to more, and I'm going to go to a CAGR calculator. In a CAGR calculator, what we've said is, I know my duration is 20 years, and I know that I need to save 96 lakh rupees. That's what we've already seen. If I want 96 lakh rupees after 20 years and I have a lump sum amount of, let us say, 10 lakh rupees, then how do you read this particular page? You're saying, आज के ज़माने में मेरे को 10 लाख रुपए है. If I need to invest it for a period of 20 years to reach my goal of 96 lakh rupees, I need to go and find something which is going to give me around a 12% CAGR. Now, what you have to do is, if you understand this, you got to map this to your bucketing, right? And we talked about bucketing. We said anything 7 to 10 years and above falls into the pure equity scheme. In the pure equity scheme, we said a good expectation to have is 12%. And therefore, what you are seeing is, if you are looking to invest for a period of 20 years and you want 96 lakhs, agar aapke paas 10 lakh rupe aaj hai, you have to go and find a fund that has the potential of generating 12% CAGR on a consistent basis. So you will be investing either in an index fund or a mid cap fund or a small cap fund or a combination of all these three put together, because they have the capability of generating these kind of returns for you. Is that fine? If that's fine, give me a thumbs up as far as that is concerned, right? If that's fine, give me a thumbs up as far as that is concerned. Yeah. Gansham, step up SIP calculator is also okay. But again, step up SIP calculator mein kya hota hai? It is saying every year you should increase it by 10%. I actually don't agree to that, because what I think is a little different. I think if you are just starting out your investment amount, you will have to increase it at every given opportunity by as much as you can, right? As much as you can, because kya aapka base bhi lower hai, right? Your base is also lower. So as the base is lower, to go from 10,000 bucks SIP to 20,000 rupees SIP a month, that's 100% increase. That can be done fairly fast. But to go from 1 lakh rupees to 2 lakh rupees a month, that might be a little slower. So I'm only trying to shape your thinking over here. Let's not get too technical. The only thing I'm trying to tell you over here is, do you realize that you need to keep topping up your SIP amounts at every given opportunity? That is the only thing that we are trying to put down over here. Okay. Now, over here, what we're saying is you are looking at 12% CAGR. So we've identified what kind of funds we give. But you need to review your portfolio as well. Suppose you've been investing over here for 5 years, and after 5 years, you will find that the funds that you have invested in have not given you a 12% CAGR. They've given you only a 9.5% CAGR. Matlab, you're behind the ball a little bit. If you're behind the ball a little bit, what do? One option that you have to do is that you can top up your investment amount. If you have another couple of lakhs to put in, top that up. And all of a sudden, if you've increased your investment level, then the returns that you've aspired to achieve that goal also comes down a little bit. Right? Obviously, there will be an element of catch up that is happening, but that is one adjustment that you can do as far as that's concerned. And again, it's an opportunity to keep topping up your amounts at every given moment, at every given time that you can. I'm going to end by explaining you what glide path means. And when I say glide path, today your goal is 20 years low, and you are looking at therefore investing in pure equity funds because that is the bucket that it fits in. But as your goal reaches closer, as you spend more time in the market, 20 years becomes 19 and 18 and 17 as your goal comes closer. Basically, what I'm saying is after 15 years, समझो 15 साल बाद, then the same goal which was 20 years away becomes only 5 years away. Do you agree with that? Because 15 years have passed, right? So a goal which is 20 years away becomes only 5 years away. Doesn't your bucket change? Your 20-year bucket was very different. The risk profile of that bucket was very, very different. But now your goal is only 4 to 5 years away. Doesn't your bucket change? If your bucket change, it means that you need to change the kind of funds that you are investing also. So glide path management essentially means that you are managing the risk profile of your investments as you are gliding closer and closer and closer to your goal, and therefore review and monitoring of your portfolio becomes a fairly important and fairly regular thing to do. All right. I'm going to end this presentation now by moving and talking about the last slide. We are going to have a look at, it's not just future insights at 15 years down the line, Prasad. Suppose you have a goal that is only 8 years away, right? Suppose you have a goal that is only 8 years away or only 5 or 6 years away. And as you're reaching closer to that goal, then you need to probably change and move the bucket from one to the other over there also. This was just an example that I have gone and given you, right? It's just an example that I've gone and given you. So that is what that's what it is. If you are achieving your goal, when I say achieving your goal, like I keep saying, it means you're going to utilize the money. So if you've already reached that, if you've reached your goal a couple of years in advance, then that's great. But you've got to manage it, because remember, the money is there to be used at that point of time. All right. Okay, finally, and this is going to be my last slide. I am saying this is MarketMaster for the do-it-yourself investor. I think the ET Money app. Have you all downloaded the ET Money app? Are you all using the ET Money app? I think it's a fantastic app, and it's so easy to get started. The first episode of MarketMaster, we showed you what is possible. We showed you the power of equity. We said that it allows you to dream big. All right, and it's a very motivational webinar. Once again, hit like or subscribe on this channel in case you think that, in case you want to keep abreast of when we're going to run that webinar next. I think it's a very, very powerful webinar. So that helps you to get started. And what we've covered today is, I hope you've got some clarity in terms of how you want to prepare yourself for investments in a very structured way. All right. If you are able to visualize it, if you've been able to understand it, then that's fantastic. So what you've got now is you've got a plan. And like I said, it's a plan that you can understand the steps, you can visualize, you can do all these sorts of things. What do you need now? What you need is the patience, you need the discipline to be able to follow this plan. Right? Plan hona is a great thing. Now you need the patience and discipline to follow it. And the question is, how easy is it? Is it easy to go, and is it easy to follow your plan? And evidence, at least historically, suggests it's not easy to remain invested for long periods of time. And the need for professional assistance, the need for conviction in your investment philosophy increases as the stakes increase. What do I mean by that? Today, I've grown to a stage where I'm doing, let us say, a lakh rupees a month of SIP, which means ek saal mein I'm doing around 12 lakhs, which means in 5 years I've invested 60 lakhs. Let's assume the value of 60 lakhs has become 80 lakh rupees. Okay. If the value has become 80 lakh rupees, then all of a sudden that's a big lump sum amount, right? That I have gone and that I have kept over there. Now, if market falls 30%, then that 80 lakhs is going to go close to around 50, 55 lakhs. It becomes very tough on the heart. All right. It becomes very, very tough to live. But if you're a recent investor, you're not going to be bothered by 20% falls that much. If you've just started out your journey of investing, then actually, as an SIP investor, you should be happy that the market is down, right? Because you're spending more time to be able to accumulate units as far as that is concerned. Okay. So, what we're going to do is, and this is going to be the next episode, we're going to actually talk about something called the disciplined investor, which is the role of discipline, the role of asset allocation as far as your investment journeys are concerned. Okay. With that, thank you very much. I've taken maybe, yeah, a couple of minutes above the 1 hour that I had scheduled out for myself. I hope all of you found this presentation to be interesting. I hope you all found it useful. And I hope it's given you the opportunity to make some small changes to your portfolio. Maybe you want to introduce some passive funds into your portfolio as well. And more than anything, it's just given you some clarity in terms of how to go and approach your investments. All right. Give me a thumbs up, give the video a like, give a nice subscription if all of this is fine. If you haven't attended the first webinar and you want to attend the third webinar, again, just make sure you like the video. You can follow me on LinkedIn. There are various things that you can do. And if you have any queries, which is not something that I might be able to answer all of them today, then you can actually drop an email to marketmaster@etmoney.com. Let me just put it out for you. marketmaster@etmoney.com. All right. So drop your queries over there, and we will be sure, or I'll be trying sure to answer this. All right. Overall, what did you guys think? Was this useful for all of you? Did it give you some amount of clarity? Right. What I'm going to do is let me go and try and answer some of these questions right now. I'm going to have to scroll up because there are so many questions that you all have asked. Right. There are so many questions that you all have asked. Where do I even start? Well, let's start maybe from the top somewhere. Okay. Naresh, I joined late. Active or direct में क्या difference है? भाई साहब, please go through this webinar, go through this again on YouTube at your leisure. You would be able to see it. Ujjwal, can we compare active funds and passive funds return? I don't know if you can compare it on the app like I showed you, Ujjwal, but if you have a look at any of the fact sheets or any other website, that should fairly be there, right? But all of this actually gets factored into the scorecard, that gets factored into the ranking. So you're looking at something which is a little deeper. Okay. Okay, let me just go on. Everybody's answering everybody else's question. All right. Mohit, you want me to review your portfolio? You want me to review your portfolio? Okay. Well, I'm not going to talk about too much of this, but like I said, if this is just you are investing for one goal, which is one goal is wealth creation, then I think the only thing that is missing from your portfolio is a large cap index fund. All right. So that might be something that you can introduce as part of your portfolio. I hope you keep topping up your investments. I hope you're not doing it 2000 bucks for the long term. When did you start? If you started, I think a top up should be done at least once a year. Okay, a top up should be done at least once a year. Again, I think the key is not about what funds you select. The key is, can you go and make investing a habit for the next 3 years and 5 years? If you're able to do that, no, then at the end, you're only going to look at asset allocation. You're going to apply a lot of what you have understood and learned and probably absorbed today, and what you're going to absorb in the next presentation on a disciplined investor also. All right. Ankit, so in my opinion, for goal of 10 years and above, we should invest only in passive funds. मैंने कब कहा? You should invest in pure equity funds for goals of 10 years and above. And pure equity funds can consist of both active and passive, right? So I'm not saying 10 years and above only invest in passive funds. You invest in pure equity funds. And pure equity funds means the Nifty index fund is also pure equity. An actively managed mid cap is also pure equity. So a mix of both is what I would probably say. All right. Ram is invested in Parag, Flexi Direct, and Mirai Asset Tax Saver SIP. Very good. Keep increasing your investments. Hope all are direct plans. Yes, if you're investing through ET Money, actually everything is direct plans, right? Ram, you are planning to invest in Cam Regabo, small cap, and UTI Nifty 50 index. Don't procrastinate. Why don't you get off this and do it right now? Right, Mohit, I've answered your question as well. Gansham, step up calculator. Yes, I think the basic funda I was trying to get at is keep increasing your SIP amounts or keep increasing your investment amounts. Okay. Can you show that inflation toggle button again? It's pretty cool. Just go to ET Money's website, Naresh, and you would be able to see, in that SIP calculator, how to toggle that on. Okay. Then obviously, if I invest 1,000 today, then after 10%, it will be only 1,100, which doesn't make sense. Yeah. So when you started off small, you can keep increasing by larger amounts, right? Rajesh, regular top up, if we have some big amount, is good or not? Every opportunity to put money into the market is a wonderful opportunity, and you should not miss it. Okay. What goes on? GR, no, don't change. If my accumulation amount is 3 4 crore, I will stay invested in equity. Yeah, of course. I mean, look, then and someone wants to ask about rebalancing also, right? Look, it depends on risk reward. If you're going to continuously rebalance your portfolio, there is a good opportunity that you're going to give up some gains as well, because you're reducing equity amount rather than leaving an inflated equity amount to compound in over there, right? So check out, I think there is a good video on rebalancing as well, which have been covered, but I can't cover everything in 1 hour, guys. All right. Okay. Thank you, GR. Appreciate it. You've been using the app for the past 2 to 3 years. Very good. Ankit, again, okay, you've asked your question. I've answered that particular question. Ram Anand, what would your investment idea be for an SIP of 10,000 a month? Which funds will you choose? Well, it depends, and there's no right thing. Listen, it's different for everybody. I would choose one large cap fund, one mid cap fund, one small cap fund. And depending on how much or how comfortable you are with volatility, I would maybe probably do 5-3-2, right? I would invest 50% in the index fund and 30% in a mid cap fund and 20% in a small cap fund. But there are other ways to do it as well. People invest in flexi cap funds, two different flexi cap funds. But I like to keep it simple. And again, Ram, if you've liked the video and you're going to attend the, I think we might try and run it next week, the webinar on a disciplined investor. It might give you a little bit more clarity. But again, like I said, you can't go wrong with an index fund, an actively managed mid cap, and an actively managed small cap fund. All right. Akagra, no, don't worry. It is in the scope outside the video. I personally don't look at investing in NFOs. There is no benefit absolutely of investing in NFOs. Let it go and let it get a little bit of track record. There are already existing funds with a track record. No, तो उनमें उसमें जाके पैसे दे दो. Just because you're getting something at rupees 10, you should not be seduced by it. All right. Okay. What else are we looking at? Okay. No better, no better. You all are answering each other's questions. How to rebalance MFs, when to move out of one, when to track it. I'm not a big fan of selling my mutual fund and getting out of a mutual fund, but I would say you got to stick to asset allocation. So if you are having multiple goals and if you are following the bucketing strategy, I think keep it simple, right? You don't need to chop and change too much, as you are just keep making sure that you are in the right bucket at the right time. If you are in the right bucket at the right time, that's almost as if you're rebalancing it as well, right? Little bit changes you can keep making, and I always believe rebalancing should be by adding more money, not by reducing money and taking money off the table. All right. Prasad, you want me to review your plan? Okay. An ICICI Nifty 50 index 10K, a blue chip equity 10, Access blue chip. So I think you've got too many mid caps. I would probably look at reducing. Oh, sorry, you've got too many large caps because your Nifty 50 is large cap, your Can Robeco is large cap, your Axis Blue Chip is a large cap. As I showed you in that particular, overlap, that there's a lot of overlap over there actually. So I think you can, you know, maximum your portfolio should maybe be of around 5 funds, and I think you can probably add a flexi cap or an international fund to this portfolio. I think you've got too much in the large cap space. So maybe consolidate your large cap. That's maybe something that I can do. Okay. Akshay, does it ever make sense to do indirect, for example in dividend paying funds? Indirect का मतलब क्या होता है? I don't know what indirect means. Say a direct is at INR, while is that INR, while indirect is INR 25. Sorry, Baba, I don't understand that question. Right. Ankit, Warren Buffett says market beats 90% of active funds in the long run. Is this true in India as well? I think what we've started seeing in the large cap space, because everything is so tightly defined, maybe the percentage play is to invest in index fund. But otherwise, it's okay. India is still an emerging market. I think there are still opportunities. We're not that efficient as yet, but certainly it is something to keep an eye on, right? It is something to keep an eye on. All right. Okay, I think I'm done. I think I'm done with most of these. Use ED money. Your father took an SIP in a regular plan 5 years ago. Very smart dad you've got. Is there any way to change or increase that? Yeah, of course. Stop your SIP over there and restart an SIP in the same fund over here. As simple as that, right? So that's exactly what you need to do. All right. Like the video, hit subscribe, find me on LinkedIn. I hope this was worthy of your time spent this Friday afternoon. And I'm going to call an end to this session. So thank you very much. I hope this was helpful. And we'll do a few more of these. So I hope to see you that over there. All right. Thank you very much. Have a great day and a great weekend as well. Bye.